Today we are going to continue the capital budgeting, and now the topic is investment evaluation techniques. To evaluate any project financially, you have to take up any of these, or in some cases a couple of, or maybe more also, uh, to evaluate the project. You need to take up any of these techniques, or it may be one in some cases, it may be two, it may be even more. Now we will look into one by one each technique. How do we evaluate? Payback period is a popular and most easiest method of evaluating a project or an investment decision. Then second one is net present value. Now this takes into consideration time value of money. Third one is internal rate of return, the rate at which the NPV is 0. Then fourth is profitability index, PI. Fifth one is accounting rate of return. In all these 5 techniques, 2 are traditional, which do not take into consideration the time value of money. You may ask me, time value, what is time value of money? You have a separate topic which you have already covered in your financial management. Time has a value, meaning today's rupee is not the same after 1 year. It's not the same value after 10 years. Can you check back? The land which was bought by your grandfather 30 years ago, is it the same today? No. He might have bought for 5,000 30 years ago a piece of land, a 200 square yard plot, but today that's about 2 crores. Where is 5,000 rupees and where is 2 crores? Is there any improvement in the land that is made? No. In this 30 years, the plot exchanged the ownership, maybe about 4 or 5 people. And when they exchanged, is there any additional value? Hardly. There may be building constructed. Now, what's the worth of the building? Building is an asset which is deteriorating. Even if you take into consideration building, that is a separate value. It is not land, it is building. When you record it in the books of accounts, land and building we record. So therefore, land value changes with the time, but money is this 5,000 in the beginning and 2 crores after 30 years. How the money is carrying value? Time value of money. Time value of money. Time value is inserted in technique 2 and technique 3 and technique 4. In these 3 techniques, 2, 3 and 4, time value is incorporated to exactly assess the project. It is understood that today's 100 rupees is not 100 rupees worth after 1 year. Today's 1 crore is not 1 crore worth after 2 years or 3 years. The digits may be there. The figures on the currency may not be changing, but can it buy what you can buy with 1 crore today after 5 years? This 1 crore what you can buy today, you cannot buy it after 5 years or 10 years. That is value of money. Value of money gets deteriorated with the passage of the time. Okay, let's come back one by one. Payback period. The time taken to recover the investment you have made on a project is the payback period. How many months you are taking to get back what you have invested? How many years you are taking to get back what you have invested? Let's say in this example, 50,000 if you have invested, every year if you are getting 10,000 return, when you look at return, annual return. When it is annual return, you should understand it is EBITDA. What is that? Earnings before interest, taxes, depreciation and amortization. It is the net profit. Net profit after depreciation, taxes and amortization. That is the value this 10,000 is. Okay. Every year this project gives you 10,000. The EBITDA is 10,000 every year. Then what is your payback period? The initial investment by the annual return gives you the payback period, the number of years to recoup what you have invested, recover what you have invested. Now let's look at the interpretation. How do you interpret this value 5 years? Longer the duration you're taking, more worthless the project is, or the shorter the duration is, more acceptable the project is, right? And when you're looking at evaluating this, you will go for what is the payback period of a similar kind of project in the market, in the industry, or in the economy. Shortest payback period project is accepted. Even that has to be checked with the industry standards. Next technique is net present value. What is net present value? Present value of inflows minus initial investment, or I can say present value of inflows minus present value of outflows. Let's say 10 crores you are investing today. What is 10 crores today? It is 10 crores. The present value of 10 crores today is 10 crores. Today's rupee value, if the discount rate is 10%, today's rupee value is 1 rupee only. But after 1 year, if the discount rate, if you think that the money gets deteriorated, discounted by 10%, after 1 year, this 1 rupee value worth would be only 9.09. It is just 0.90 paise. It is just 0.90 paise, okay, or some odd digit figures, okay. So, yeah, in this case, the present value of the initial investment is 10 crores only, 10 crores, and the future values you look at. When you take the discount rate 10%, you will check how this invested amount, giving returns, yield every year. Yield means what I just now told you, it is the EBITDA. What is the EBITDA at the end of the first year? What is the EBITDA at the end of second year, third year, fourth year, fifth year? Let's say if the project gives, for 10 years, the returns EBITDA, those returns also again, look at this. When you look at EBITDA only, it is, minus it became. How did you arrive at EBITDA? You take sales revenue and deduct all the manufacturing expenses or trading expenses, then you get gross profit, then deduct all the administrative expenses, then you get administrative and selling and distribution expenses, then you get net profit before taxes. Then deduct taxes, net profit after tax or profit after taxes or PAT, and then deduct the depreciation, and you go on like this. So, EBITDA is something before the deduction of the depreciation, before the deduction of amortization, that is EBITDA, right. So, this every year's yield is, after getting this amount, this every year yield is coupled with the discount value. Now, in this example, if you look at, you will get more clarity. The cost of this project in this example illustration is 1 lakh. Every year you are getting 30,000 per year. 30,000 means this is EBITDA, 30,000 EBITDA every year. You are getting it for 5 years. And if the rupee gets discounted by 10%, this 30,000 actually absolute amount would be 1,50,000. 30 into 5, 1,50,000. But when you apply the discount value, when you apply the time value for the money, this 1,50,000 rupees absolute figures are not 1,50,000, but it is only 1,13,730 as you see it on the screen. It is 1,13,730. But absolute figure, if you look at, it is 1,50,000, right? This is the EBITDA total you get for 4 or 5 full years. And take the initial investment. How much you have invested initially? You have invested 1 lakh. How much you got all these 5 years? You got 1,13,730. And what's the difference? Difference is 13,730. And this difference is net present value. Present value of inflows minus present value of outflows, cash outflows, gives you net present value. Come again. The present value of inflows and present value of outflows is what net present value is. How do you interpret this net present value? Any positive net present value you can go with, but if there are alternatives and there are all projects in hand, if they are giving positive net present values, then you can arrange it or rank it. The highest NPV value project is taken given the top rank. The next highest is given the second rank, the next highest the third, and then fourth, then 5. So, you will rank the projects. Select such a project which gives the highest net present value. Third is internal rate of return. Now, it is as simple as this. It is the rate at which the NPV is 0. In the previous case, we were using the discount rate and checking what is the net present value. But in this case, we are identifying, we are trying to trace the return. What is the return that we get out of this project? What is the return? And what is the return at which the NPV is 0? Base minimum, at least it should be such rate where the present value of inflows and present value of outflows, just you have seen in the previous slide, is equal to the present value of inflows minus present value of outflows must be equal to 0. Okay, if it is 0, at what rate that is 0? That rate is known as internal rate of return. Now, look at a short question, a simple question for conceptual understanding. What is the IRR of an investment that doubles in 5 years? Look at this. If you invest 1 crore now, it should become 2 crores. If you invest 100 crores, it should become 200 crores. That's a question. So, what is the IRR? What should be the rate, you can say? What should be the rate if your investment has to be doubled in 5 years? Look at the answer. You know, there is a 72 rule. What is this? 72 rule means divide the 72 by 5. Divide the 72 by 5 and the answer is 14. You know, in 5 years, if you invest this money, in 5 years you will get 14% return. 14%. The internal rate of return is 14%. Again, come back to the concept. What is this 14% internal rate or what is this 14% IRR? It is the rate at which the NPV is 0. Again, what is this NPV 0? It is the present value of inflows minus present value of outflows is equal to 0. How do you interpret? Now, if the overall or weighted average cost of capital is less than the IRR, internal rate of return, you can accept the project. But again, if there are competing projects with all greater than the overall cost of capital or weighted average cost of capital, then you should go for such a project where it is high. Then profitability index. Profitability index. What is profitability index? Now, in all these 3 cases, previously also and this also, what we are doing is we are incorporating time preference for money or time value of money. What is that? With the passage of the time, money's value gets deteriorated. That's the basic underlying factor, underlying concept that you should not forget, but bear it in mind. Profitability index also is using time value, time preference for money for the cash flows that are being considered to assess the project. PV of outflows, present value of outflows by present value of the investment. In the previous case, or you can take a fresh example just as you see on the screen, PV or the present value is equal to 50,000 and investment is 40,000. Present value 50,000, investment is 40,000. You have invested initially 40,000. If you invest, the total present value is 50,000. What is the PI? Profitability index. The total return by the investment, that is 1.25 is the profitability index. The interpretation is any project which has PI, profitability index of greater than 1, any project which has a profitability index of greater than 1 can be accepted. Lastly, accounting rate of return. Accounting rate of return is, it is the average profit over the investment. Average profit over the investment. For example, the cost is 60,000 and the profit is 9,000 per year. When you look at the average profit, again EBITDA. When you look at the investment, it is the average investment. Why do you say average investment? There may be some purchases of machinery and some sale of machinery. Due to obsolescence, some machines might be sold. Due to modernization, some machines may be disposed of, just as we have discussed earlier, right? So, the profit is after adjusting for depreciation and amortization and taxes, okay. So, the cost is 60,000, profit is 9,000 per year. What is the accounting rate of return? Accounting rate of return is the average profit by the average investment. Average investment means purchase and any new additions during the year, okay, that also you have to consider, into 100 gives you the accounting rate of return. In this example, it is 15%, 9,000 by 60,000 gives you 0.15, and if you multiply with 100, it gives you 15%. How do you interpret this? If the ARR is, accounting rate of return that you have calculated, is greater than, if it is bigger than the target return, then accept the project. If it is smaller, then you will be rejecting the project. So, in all these techniques, 3 are modern techniques. Modern techniques means they are considering the time preference for the money, and 2 are traditional, wherein in payback period there is no time preference for money included. Later on they have improved the payback period also. You know, when you are calculating payback period, you should also consider the time preference for money, time value. Therefore, you adjust all the returns over the years that you get, multiply with the discount factors from the table, PVF tables, then you will get the adjusted payback period, okay. So, finally, there are 5 techniques, 2 traditional and 3 modern techniques, or techniques that consider time value, okay. Fine, there may be some theory question, or sometimes you may be facing the interviews, or sometimes you may be writing the examination to take up some employment in your public sector undertakings. So, in that case, the interviewer may ask you what is the difference, major difference between NPV and payback period. You might have got 9 CGPA 9 or 9.5, 9.8 out of 10 or 98% or 95%, but still very often students struggle to answer these basic questions. They might have written excellent in the examination, but because they miss these techniques and they are unable to face the interviews, and not because there are not many jobs in the finance segment or finance sector. There are many jobs, but there are very few people qualified, employable in those roles because they miss these basic concepts, which are not very tough, but which are just ignored out of ignorance. Now, look at the payback period. Payback period doesn't consider time value for money and uses partial cash flows. And you say shorter the payback period and more acceptable the project is. Just as as many say, and I also say, if a project is giving bumper and super profits and the payback period is as less as 2 years, and after 2 years there are no returns at all, you got back what you've invested in 2 years, that's it. The project after third year, it gave little profit, and fourth year even little profit, fifth year there is no profit at all, there is no return at all. Would you consider such a project to launch? No, definitely not, because you want consistent returns over a period of time, not just short term returns. But payback period says shorter the payback period, shorter the time to recoup money from what you have invested, more acceptable the project. But now when you look at the duration, when you look at the consistency of the returns, then you reject it. Okay? Then net present value uses time value for money, and it accepts full cash flows. The previous one only partial, it uses only partial. Let's say if the payback period is 5 years, what about the cash flows after 5 years? That's not considered in payback period. But in time value, in net present value, every year cash flow is considered. Every year cash flow is discounted. Okay, after discounting, you take the difference between inflows and outflows, present value of inflows and outflows, then you get net present value, and net present value which is greater than 0 is accepted. Net present value which is greater than 0 is accepted. Okay, let us look at the IRR. This is also using time value or time preference for money, and it accepts if the IRR is greater than the weighted average cost of capital, right? This is also using full cash flows. It is not ignoring any cash flows. Then PI also is using time preference for money, time value of money. Okay, and it says if PI is greater than 1, it is accepted. Then ARR also, accounting rate of return, is traditional, not the TVM method. And as we discussed, 3 techniques to consider which are considering time value of money, and 2 techniques which are traditional wherein no time value is considered. Look at this ARR based on accounting profit. Okay, it's easy to calculate but ignores the time preference for money. Now capital rationing. What is capital rationing? Capital rationing is using the judicious, it's just nothing but judicious utilization of available scarce resources. The financial resources are scarce. It's not that we have sufficient and abundant money, however big the company is. The financial resources are very limited, scarce. Those limited resources, how best you can utilize, judicious utilization of available limited resources. That is capital rationing. So, when it is limited, then comes the question of capital rationing. I'll tell you a funny example. When the income levels were very low, one day my dad didn't have money to get the banana home in my childhood. He brought just every day he used to get 1 dozen, 2 dozens like that. One day he didn't have any money, but while coming home, he brought just 1 chakrakeli banana. Okay, that 1 banana he made 6 slices, distributed each slice to all 6 members, father, mother and 4 children. Look at this. This is exactly what done. Capital rationing. You have just money enough to buy 1 banana. Likewise, in the case of projects, you have very limited resource and how best you are using them. Projects ranked using net present value or PI, you will be, there are 5 techniques, you will be ranking those 5 techniques using the using all the techniques, and particularly the net present value and profitability index, and chooses the projects with the highest returns under budget. There's a budget constraint and you are very, very careful. Then risk analysis in capital budgeting is our next topic. We will catch up there, and where we will be discussing sensitivity analysis, scenario analysis, risk adjusted discount rate, and which helps in uncertainty. Finally, capital budgeting is crucial for long term success, and it uses appropriate evaluation techniques. And good decision means optimal capital use for a better profitability. This is an effective decision. Thank you very much.